Has APRA just killed investment lending? That's the headline screaming across Australian property news all week. With new lending rules targeting property investors with high debt levels, we wanted to find out, will this actually slow things down? Or, like with previous crackdowns, will investors barely feel it? We've got Callum Rhodes, our Lord of Lending, back to dig into things and to get clarity on what this means for investors in 2026 and beyond. So let's get into it. Callum, what an interesting time to be a mortgage broker.
Absolutely. Yeah. And I think what we need here is editing team. We need to put big alert, flashing lights, big levels of concern. No, it's certainly not the case.
Let's just cut to the punchline, Callum. Can we just let's just let everyone know that property investing is dead. Everyone should sell all of their properties. You can no longer get finance. No one can invest anymore. Is that sort of what we're looking at here?
Yeah, definitely. This is exactly what I said last time. No, certainly not the case. It's really the headline within the headline. A lot of people have been caught up with, about what the media's been suggesting and what some of the headlines say. But really, when you delve deeper into it, there's a lot more that you need to consider, and it's certainly not doomsday for property investors.
So, Gabby, do you want to lead on? I've got a few questions to jump off the bat, but you've also collected some questions from the community because I think this is a really interesting topic. Do you want me to just shoot some in there, or do you want to start?
No, if you want to go off, I do have a list of questions that have come through, but if you've got something off the top of your head now, it's all good.
Okay, I kind of want to start. I know what everyone wants is the detail. They want to know what's APRA doing. What does this specifically mean? Everyone loves the detail. Everyone loves to get right down in the weeds. I'd like to kind of start in a sort of slightly different position and I'd love to get your opinion on this, Callum, as well, and then we can kind of move into the more mechanics of all of this kind of stuff. I see that this is every year that we've had this business, there's been some headline. When we started in 2019, there was talk about scrapping negative gearing tax. There was the Royal Commission into banking. Then there was this other thing, and then there was something else, and then it's interest rates going up, and then it's interest rates going down, and then and in fact, when interest rates started going up, they changed. I think they lowered the DTI thresholds a little bit then, and at the same time, interest rates are going up. So every single year, and probably every single year for the last 30 years, there's been some reason that if you wanted to get freaked out, you could probably find a way to get freaked out about something in the property market. This feels like the media is finding things that are going to make people feel excited, i.e., if it bleeds, it leads. And real estate is the unofficial religion in Australia, that everyone loves real estate. And so whenever there's an opportunity for the media to take something that may be relatively innocuous or actually may not be meaningful over any kind of significant time horizon, 1, 3, 5 years, they have a tendency to spin that up into something that's going to cause people to climb the wall of worry. And I wonder if you think that this is just one of those circumstances where the headlines are overinflating the actual importance of what's going on here.
Yeah, absolutely. I mean, if you want static investment conditions, go and buy government bonds or something. It doesn't matter what market you're playing in. There's always going to be aspects of the market that you have to adapt to. But like you said, they're historically, APRA have tried at various different times to manage things as they see need to be managed. The banks have tried to do the same thing as well. But inevitably, the property market has soldiered on, and there's a need for adaptability in these moments. But it's certainly, not a situation for panic. Absolutely.
Yeah, but isn't that always the case? What you just said there is there's a need for adaptability, but there's always a need for adaptability. If we go back a couple of years, we were buying properties that were sort of 6, 7, 8% yielding properties. We're not buying those now. Okay, things need to change. I know someone who built a really good business, not ginormous, but really good. A pretty decent, successful business. But their entire strategy was based around finding splitter blocks in Sydney and then buying and then subdividing and then building a house on the back. That was the whole strategy they had. But then conditions changed, cost of building materials went up, all that kind of stuff, and their entire thing just stopped working. They just couldn't do it anymore. So necessarily, isn't adaptability just a necessary requirement of being a successful investor, because without that, like you're always going to get stuck. Like the way that I think about this is basically the one thing that you need to continue to be as a property investor is adaptable. Because if you have a preformed opinion, like let's say you started investing 50 years ago, well, guess what? Whatever you were doing 50 years ago is not going to work today anyway. So you necessarily must stay adaptable, must continue to be adaptable. And if you can accept that that is one of the most important traits of being a successful investor, adaptability, then everything else is just data, and you get to kind of like swim with the tide. Do you think that's kind of a fair position to take?
Definitely. And if we, I'm sure the more experienced property investors in the group that are paying attention here, you're sitting there nodding your heads, appreciating that throughout your journey in investing, there's been various different changes along the way that you had to adapt to. And maybe some of the newer property investors in this group, you may have some level of concern about, seeing media stories about APRA changes and changes to market conditions. But it's really just about being able to have peace with that and appreciate that with the right advice in your quarter and the right level of process and intent. It's just another one of those speed humps that you have to navigate through to continue to scale your portfolio.
Nice. Okay, Gabby, why don't we start getting into some of the questions we've gathered out of the community? So I think they'll probably unpack where people's real concerns are.
Yeah, we can in a sec. I was just thinking through, so that the changes that they've actually brought in, or they're flagging to bring in from February, is the 6 times DTI ratio, right? So debt to income ratio of 6%, being a maximum cap for banks to only lend 20% of their new loans to anyone with a DTI of above 6. So Callum, in the last couple of weeks, how have you kind of tackled that conversations with clients that have come to you kind of concerned about this?
Yeah, it's a really good point. And I think the first thing that you want to pay attention to is the nuance in the message. So, the statement is that they're not going to have more than, they're not able to have more than 20% of loans above 6 DTI. Now, the reality of it is, it's very difficult to get above 6 DTI in the first place. And the volume on book that banks already have above 6 DTI, it's super low because it's just not feasible for most people. And then the other thing which I think is lost on a lot of people is that the definition for what 6 DTI is varies from lender to lender. So APRA haven't come out with this uniform rule that says this is included in debt to income calculations, this is not included in debt to income calculations. All they issue is a broad guidance to lenders that 6 DTI need to reach some cap, but it's up to them to interpret exactly how they do that. So you can have the same scenario that by Bank 1's calculation, it's only DTI 5, and by Bank 2's calculation, it can be DTI 6, purely because they are deciding what they think needs to be included in their DTI calculation. So it's super fluid.
Just to expand on that, so like just a practical example might be one lender, like let's say you have, you've bought properties and they're kind of in separate trusts, for example. One lender may look at the debt that's within those trusts and say, okay, that's going to contribute to the debt side of the debt to income component. And another lender may say, well, we're not going to look at those trusts, and therefore the total debt to income may, is that sort of what you're saying? Like that some things may be included or excluded from the income side's a little bit harder. Like it's pretty clear, right? But it's like, what are they including in the debts is probably where the flexibility comes from, right?
Yeah, so that's certainly one nuance to it. So let's say, for example, if you're applying for a loan and you have some other debts in another trust, for example, which that bank is not taking interest in, and it's been confirmed that it's profitable by an accountant's letter, most banks aren't including that in their DTI. So it's not necessarily an entire portfolio DTI. But the other thing, even more nuanced, is, for example, some lenders will treat your HEX debt, how much you owe on your HEX, in their DTI calculation. Others will not. Some will include, maybe you run a business and you've got $100,000 of chattel mortgages in your business. Some will include that in the DTI. Others will not. So there's actually even further nuance, which is really up to the banks to determine what they want to do. So that's certainly something that we will rely on here. The banks will continue to show their creativity to tow around this challenge that they have with DTI limits. Like, oh no, based on the way that we assess DTI, that's not in our DTI metric. So this client is actually below 6 DTI.
So can I ask a question then? Like, has anything actually changed? Because sometimes you get these press releases and they make this big announcement of something that is actually already happening, but they've just decided to kind of like make a public statement about it. Because to the best of my understanding, and kind of from what you're saying, like most, like the banks that are regulated by APRA, because obviously there's some non-bank lenders that are not regulated by APRA. But for the APRA regulated lenders, the 6 times DTI kind of recommendation or policy or whatever has always been in place, or has been in place for a very, very long time. And so is the kind of position of like, where, CBA is making a public statement, we're not going to go, but like, is it actually they're just saying what they're already doing? And also further to that, you made a comment internally around how it was actually related to their workload more than anything else. But the sort of making the statement around this like cap on DTI, are they just making noise about stuff that they're already doing anyway? Like, is it even actually anything different?
Yeah, it's interesting. So this one particular most recent release about the DTI limits, if we were to cross section different changes that we've had in the past few years, I would expect this one to honestly do the least. Like it sounds like a powerful stance, but to go to what your point there was, Goose, yes, the banks already have had some level of concern about high DTI lending. Different banks have had different restrictions above 6 for periods of time. Their credit policy can be different above 6. So yes, it's already been happening. But I think the other thing is to cross-section different clients. If you're an owner-occupier and you're looking to go out there and, keep up with the Joneses and buy the nicest owner-occupied property you can, you definitely will be hit hard by this, because that's right at the coalface where you will feel the influence of that. But outside of that, if you're a savvy property investor, even though the banks have been paying attention to it, you've been able to navigate through it for the past 2 years, where there's already been, so previous to this, there's already guidance from APRA that they have some level of concern about anyone being above 6, but it's just they've gone that next step further and specifically said, okay, well, now we have set this threshold, but that threshold is still unlikely to be topped anyway.
And so is that a regulated threshold where APRA is going to be auditing banks and saying, like, if you go above this, there will be penalties, or is it still guidance?
So it will be regulated, but again, they're not stipulating to the bank what needs to be in their DTI calculation. So Commonwealth Bank will say, yep, we're below 20% of 6 DTI, but their metric may be far more favourable than Westpac's, and it's really up to them to determine it.
Yeah, interesting. Because like, what I think is interesting is there's been a sequence of announcements or kind of like media publications or like headlines recently, and I think it's the sequence of headlines that has started to get investors worried. First it was Macquarie came out and said we're not going to do trust lending at all, and then CBA comes out and they say did they also have a trust lending? Did they have something about trust as well?
They're not lending to new borrowers in trusts.
Okay, so they're not lending to new borrowers in trust, and then there's and then it was also CBA that said they're not going to do more than 20% of their loan book is going to be more than six times DTI, and so it's kind of like this sequence of headlines, which I think if you looked at each one of them individually, you would be able to rationalize why they're making those statements. So, for example, we covered on a previous episode, the Macquarie one was probably that they overextended their risk profile by, maybe chasing market share. Let's just put it that way. The comments on not doing new trust lending is actually more to do with their complex lending. SLAQ, I think, is that right? So it's basically it's taken them too long to process more complex lending. Yeah.
So from CBA, there's a variety of reasons why from them, but service levels, how long they're taking to assess a loan, is blown out quite substantially. But there is from them some fear of regulation, like the same as Macquarie. But you'll see them do the same thing. They'll just toe the line for a little while, and then some stage next year they'll open their policy back up and they'll be accepting new to bank customers for trust. It's just a temporary response to a regulatory environment that gives them some sort of concern as Australia's biggest bank that, attention could be paid towards them as well. Because they had the most liberal policy similar to Macquarie in recent months, how they changed it.
Yeah, and I think it's a really interesting point, and I'll come back to my other point in a moment. But the way that most of these regulatory bodies work is they want to see that a company is endeavoring to do the right thing. It's usually not a bright line of like, have you done this thing? Yes or no. If you're on the wrong side of the line, you're going to get punished. It's usually a case of there's probably a gray zone, and does it look like the company is endeavoring to do the right thing and are they moving in the right direction, right? And so for a company like CBA to be sort of publicly making statements of like, look, we're doing this thing and we're doing this thing, it's kind of making sure that APRA can see that they're endeavoring to do the right thing, which puts less regulatory scrutiny on them because they're showing like, hey, look, we're making all the noise that we're doing the right thing, right? So I think that's that's an important thing to understand as well, because it's not like, even if ASIC or APRA or any of these organizations were to go in on a company, usually they say, are you doing the wrong thing? Yes or no. Okay, you are doing the wrong thing. Okay, but are you endeavoring to do the right thing? Okay, all right, cool. Well, in that case, like, let's just see that continue and you're probably going to be fine. So I think from a sort of covering their ass perspective, I think that makes a lot of sense. Back to my previous point, though, I think what's got investors nervous is this kind of like sequence of announcements, and it's got people thinking like, oh my God, like, are we about to like, is this, can we see some path that is taking us to a place where the banks are going to stop lending to property investors, or we can't invest anymore? I think that's the extrapolation that most investors have got in their minds, is that look, there's this signal and this signal and this signal, and these headlines. Are we going to end up in a place in 3 months or 6 months or 12 months where we just can't borrow anymore? What would you say to that?
Absolutely. And I can understand why your average investor would feel like that. It does feel like this compounding effect of multiple things, aligning towards that at the moment. But I think the lens that we need to appreciate it with is that this has always happened. There's been several times in the last 10 to 15 years where, APRA have tried to whip the banks with the regulatory cane, tried to force change from them, and ultimately, demand has just gone to other parts of the market. Or what you see from the banks is ultimately banks are always towing the line with the regulators. But the reality of it is they're in the business of lending money. They need to get money out the door. And you can absolutely rely on the banks to try and skirt ways around the regulatory front to try and make credit freer again to allow them to lend more money. So using the DTI calculations, you will absolutely see banks try and manipulate the way they're representing their DTI calculations to position themselves to be able to lend further money. And if we go back in time, there was, I won't bore you guys with all the details, but there's been various tries from APRA at this. 2014, there was some regulatory changes. 2017 again, 2018, 2021. There's been various attempts from APRA to do this, but ultimately what's happened is it's just that the demand has ended up going somewhere else, which is where non-banks come into play, because that is very likely what we'll see play out over the next year. You'll see the banks, they'll be forced to relax a little bit on the investor lending front. We've already seen it, and we'll ultimately see non-banks, your Resimax, your First Max, your Liberties, your Peppers, they will start to soak up more and more of that investor traffic, particularly in trusts, and it'll just shift to another part of the market away from the banks.
Yeah, it's a really important thing to remember, because I think because banks are so large, like if you think of the big four, they're so large and they feel so ingrained as part of our society that I think people accidentally assume that they are sort of like part of our national infrastructure, as in like they're sort of like a government body, right? And that they're there as in some senses like a public good, like, that they are wanting to implement policies that would, but in fact, they are just in the business of selling debt. That's all they're in the business of doing, right? And well, there's other stuff as well, right? Obviously, but the main business is selling debt, and they look at the $11.7 trillion asset class that is residential real estate, and then they look at their shareholder obligations to accrete shareholder value, and they go, okay, the best way that we can accrete the most amount of shareholder value is through the high profit and high value market of mortgages. So how can we lend more debt? Like, how can we sell? They're not. And I think even the concept of like lending money is kind of a little bit like, oh, the bank's doing me a favor. They're going to lend me some money. Like when your mate asks you for, hey, can you lend me $100? Yeah, I can lend you $100. Like you're sort of like helping someone out. They're not helping you out. They're selling you something. It's like you go to the bank not to like, can you lend me some money? It's like, can I buy some debt from you? How much is it going to cost me to buy some debt from you? And they're in the business of selling debt. And so to your point, Callum, it's like they are going to look at every obstacle in their way of selling debt and go, well, how do we get around it? Because they're in the business of making money, making revenue, selling debt, and they're going to find every opportunity they can to continue to do that. So I think it's a really important point to remember as well.
Can I play devil's advocate here for a sec?
Yep.
So I think obviously there's, as you said, there's a series of announcements that have come out over the last couple of months relating to lending and policy changes and everything. And I think particularly with this one, because it is APRA being the regulatory body of banks, I think that's reason why people are concerned. And a part of their commentary is about that they've detected riskier lending, and so they're trying to put in these things to kind of rein that in. Do we really think there's no validity to that? Is there anything? I'm just thinking through like people listening to this that are like, okay, but it's APRA putting in this high level policy, like, and they're telling us that it's because things are getting a little too risky. Yeah. Is there nothing behind that?
It's certainly a good point, and again, using the historical lens, this is exactly what's happened every other time. And I think the bit that APRA can't remove is they can't remove demand from consumers, right? And they can't remove the creativity of people to continue to try and invest. So on the regulatory front, they can pull on one lever and then all of a sudden the demand will just shift somewhere else. They can't regulate out people's desire and belief in Australian property as an investment class. So yes, it's certainly valid, but the reality of it is there's, short of them just saying, right, banks are not allowed to lend any money to investors anymore, which obviously is not going to happen. Like, yes, they can make it more difficult, but the enterprising few out there, and also you've got to think about the free market of the lending environment, right? It's like, well, okay, well, let's say that APRA have really, strangled the banks here such that they're not able to lend to investors the way they want, but that actually succeeds. Ultimately, you will just see the non-banks soak that up because the non-banks, they're not regulated by APRA. And I just want to take a short moment to explain that for some of you guys that maybe don't understand this. So you have banks, Commonwealth Bank, NAB, CBA, etc., and they're what's known as deposit-taking institutes. So that means they offer banking services, they take deposits from clients, and then they have a range of services as well as lending loans. Now, if you think about a non-bank, they effectively get their money at some wholesale level. So whether that's from the major banks, whether that's they have their own mortgage fund, a whole variety of different ways. But effectively, they just lend money to people. They don't take deposits from people. So APRA don't have a say. They have some level of say, but they can't enforce this upon them. So the free market will soak up that demand for lending somewhere, and someone else will come into the market and take it, as long as there is still demand from investors to transact on properties.
Yeah, I think it's a very important thing to understand because again, like people get scared by these headlines, but actually, and correct me if I'm wrong, but there's significantly more non-bank lenders than there are banks. Is that a fair statement?
I mean, in on face value, it would appear there is, but there's kind of not. But I suppose there's more avenues that you can get access to non-banks from. Yeah. With various different white labels on them, I guess. But
okay.
There is plenty of them to sort of
okay. So there's plenty of them, and in fact, like most property investors, at some point they're going to move beyond banks and move to non-bank lenders anyway. I think you also made a really good point earlier, and this is really, I think, something we should think about is who does this affect the most? Like who does this actually affect the most? Because investors are going, oh, this is going to stop me investing, but sort of to the point you made earlier. Callum. Sorry, I just got distracted by Sean calling you the Sultan of serviceability. To the points you made earlier, Callum, the banks are going to be subjective around what's included in the DTI calculation anyway, right? So if you think about most property investors who are thinking strategically about their finance structuring and all this kind of stuff, probably it's not going to be really a lot different. So then who does this actually affect? This probably actually affects the homeowner that's buying in their own personal name, the first home buyer or something like that, somebody who wants to buy a home in their personal name and is getting assessed purely on like that, they don't have a complex financing strategy. They haven't they're just like, how much money are you earning and how expensive the house? And then you got to think about, well, how does that then drive demand? Okay. So in Sydney, the average house is more than 6 times the average income. Right. So the average dwelling, is more than 6 times the average income. So that means that more homeowners are getting locked out of buying in more expensive markets. So necessarily that demand also pushes into more affordable markets, which is also where more investors are playing as well. And so that actually drives growth in those kind of, say, more affordable, market segments in that sort of $400,000 to $1 million kind of price point. We'll actually likely see that driving more demand into that market segment, which will drive more price growth. Whereas you'll probably see places in Sydney where we'll see more, kind of tepid, mediocre growth because more people are going to be locked out of that market because of these DTIs. What do you think about that?
Yeah, it's definitely true. Look, and I apologise. If you're looking at buying a house in, Southwest Clyde Heights, right out there in the mortgage belt, trying to load yourself up to the eyeballs with owner-occupied debt, you really will struggle. And that's, obviously that's not really aligned with our wealth building strategy. But if I feel for you, if you're a young family out there that you want to buy a house to live in, yes, that certainly will happen. But I think the other thing at play there with your comment about, markets in Sydney, for example, the highest level of indebtedness is not in the most expensive suburbs. The most expensive suburbs and blue chip areas, people have far lower levels of indebtedness. So you're not going to see much influence there. It's just going to be that young families that perhaps aspire to, to move into the slightly nicer suburb, they're really going to be challenged to be able to do so.
Let's just segment that a little bit because what you're talking about is the the $5 million median house price and above category where most of those don't have any debt. They're mostly cash buyers. But in even in the more median markets in the capital cities, established areas in capital cities, 1 million plus price points, the level of indebtedness there is far lower than areas on the surrounds of cities. Yeah, I guess yeah, because I was thinking more like around that $1 million price point suburbs, like $1 million median house price kind of. That's where people tend to stretch to try and get into. Like if I can just buy a home in these kind of areas, and that's really where it sort of starts to break down a little bit. Those markets typically have very low yields. They're not very typically, and the demand is getting sucked out because of affordability ratios. So people are actually going elsewhere, which is also what's driving up that sort of $400,000, $500,000, $700,000 market, driving those kind of prices higher.
Yeah, definitely.
So Ben Munn has just put a question here in the chat. And just a reminder, if you're watching this not live, we do this live every Friday, well, nearly every Friday. We missed last week. And if you do come and join us live, you do get to participate by joining in the chat. If you're watching this and you're not live, leave a comment. You can ask us questions in the comments. We'll endeavor to get back to you, try and answer your questions as well. So make sure that don't feel like just because you're not here, you can't ask questions, because you can by dropping them in the comments as well on YouTube. So Ben asked a great question, or a kind of statement/question. He said, which means there won't be much effect, as by the time you get to near 4 or 5 or 6 DTI, you most likely need to move to a second or third tier lender anyway. So is there no real impact?
Yeah, I mean, that's a great way to phrase it, Ben, because the reality of it is if you're looking to scale a property portfolio with a serious level of intent, after a few properties, depending on your income levels, yes, you will be outside of the banks. And I think the other angle that you'd be looking at this with is obviously most property investors, once they really get serious about scaling their portfolio, they're thinking about alternative debt structures like SMSFs and trusts. And this is going to become even more critical in terms of DTI calculations, is how you position and structure debt. Because if we think about your property purist type investor that just buys everything in their personal name, buys low yielding blue chip assets, in a suburban areas, like that type of strategy will really be harmed by these the changes to DTI. But for property investors that are thinking 2, 3, 4 properties ahead and structuring out debt, yes, you're invariably going to be with non-banks anyway by that time, and it's a bit of a non-event.
Yeah, interesting. Gabby, have we got any other questions from the community we want to start to wedge in?
Yeah, we do. A lot of them are around how it'll impact trusts and SMSFs and things. So I will just flick through them. Obviously, we don't. Not giving financial advice, guys. If you want to speak to Callum and the team directly, we can jump in with that. But so there's a question from Gavin, kind of related. Will APRA separate investment loans from personal home loans in assessing DTI ratios?
Good question. So they're all thrown in together. Obviously, the DTI calculations work better for investor loans because there's a chunk of income that they're apportioning in the calculation, not just a chunk of debt which is the case in an owner-occupied transaction. So it's a collective assessment. But with the point on trusts, most lenders, provided they're not having an interest in that transaction, they're not going to be factoring into your DTI calculations any other debts that you may have in some other trust.
Not financial advice, of course, but pay attention to that note, because I think that's really the key. Is like, if you look at how investment strategy has evolved over the last few years, anyway, the prevalence or the propensity or need to use trusts as part of your finance strategy and your portfolio strategy has become more well known, but also it's absolutely necessary. And what you're effectively saying is nothing's changed on that front. Like, if you keep doing that, then broadly there's no real difference. Like, you need to have a structured finance strategy that is going to allow you to isolate debts in different entities as appropriate based on your own personal financial circumstances and with the appropriate advice that you get suited to your personal circumstances, all that kind of stuff. But effectively, to manage debt using an appropriate structuring method and system to make sure you're siloing debts in appropriate ways, making sure that those debts are serviceable and maintainable by the profits or returns from the portfolio at large, and whether that be through direct cash flows or through refinancing and using equity to create serviceability buffers and doing other kind of strategies like that, which is all stuff that investors have to do now anyway if they want to build a successful property portfolio. Because I think what most property investors need to remember is 71% of investors get stuck at the first property and only 19% get to two. So that means 90% of property investors never get past two properties. And the difference between the 71% and the 90% is literally just how much money do you have? Because, most investors can afford to buy one property. Some investors, if they've got higher incomes, can afford to buy two. But without a structuring strategy, you're going to get stuck at two anyway, basically, unless you're like a very, very, very high income earner. So if you want to get past two properties, which every investor does, because you can't create financial freedom for yourself and your family and create all the prosperity you desire without probably 4 or 5 properties, and less than 1% of property investors get to 5 properties, which is just crazy. You can't really do that unless you have an appropriate finance and structuring strategy, which is what we're talking about here now anyway. And if you've got that, then really none of these changes actually seem to have any impact at all, realistically.
No, and look, it may be the case that, maybe prior to this, you might have been able to get your second and your third loan with CBA, and the fourth one would have been with Resimac. Maybe now the second one ends up with Resimac versus the third one. Like, we may see some shift in the total amount of transactions for investors done with the major banks, but that's really going to be the only difference that we see here. And what we've continued to see for the past few years as well is this, with the right non-bank lenders, there's no difference in pricing, especially in trusts, with non-bank lenders versus the banks. Like, it really is just a different badge on whoever's lending you the money that you're less familiar with, that you're probably more likely to be working with as you scale out your portfolio in the short term. But eventually we'll see the banks get cunning, try to push at the edges a little bit and muscle back in on the market that they feel like they're missing out on when all the investor demand is going to non-banks because they're getting caned with the regulatory stick. Yeah.
Nice. Gabby, what else have we got?
Yeah, it's interesting how many of the comments are just relating to trusts and that whole, like, is the strategy still suitable, even using trusts? So, like, one question from David is the trust structure dead for property investing? And the context, I'm currently applying for a pre-approval via a family trust structure. When I'm ready to settle, is there a chance that loans won't get final approval because it's applied in a trust?
Yeah, that's good. That's a good question, David. I can understand why you'd be concerned. Look, pretty much universally, even when banks change their policy on what they will and won't accept, that's something that they apply, from date X, no more submissions in trusts. So if you've already had your loan submitted and it's already been assessed and approved, no, the bank is not going to rug pull you on, no longer lending to trusts. So you don't have to be concerned about that. And to your broader question and mirroring what Goose said before, does the trust structure still work in terms of the borrowing power benefits and all the rest of it? Absolutely. It's keep calm and play on realistically. If that was the strategy that you've already arrived at as being the best one to help you build wealth, you won't have any problems continuing on with it.
Nice. Gabby, are all the questions that we got from the community, are they all just variations of like, can I still borrow in trusts?
I think I saw one about SMSFs. So just to cover off on
Yeah.
SMSFs, that SMSFs are not part of the assessment either. So there's no lender out there that includes a SMSF that you may have in your DTI calculations, nor do SMSF lenders include DTI, because all SMSF lenders are non-banks. Banks don't lend to super funds. So that strategy is exactly the same as it was before. And that's definitely play on as well.
Okay.
Yep.
I'm, you can barely shut me up in a podcast episode. I remember Gabby, like a couple of weeks ago, you asked one question and that turned into like a 90-minute podcast episode. I am honestly struggling to even think of like, because because it's honestly just seems like such a non-event to me. Like, I'm like, all right, have we established that basically this means nothing? Yes. Okay, does the trust structuring strategy for property investors still work? Yes. Were there already effectively 6 times DTI calculations being used by APRA or being used by banks? Yes. Like, is there some marginal constriction at the edges, at the margins of like some people who may be affected, primarily homeowners that might be seeking to get into high price properties? Yes, but is that going to affect property investors? No, or very fractionally at the margins. In fact, arguably, maybe it's better for property investors because it's going to drive more demand into more affordable areas. There's going to be more growth. Banks are in the business of selling debt. They're going to be looking for ways to give you debt, not looking for ways to hold you back from debt. Like, I don't even know, like, how many other ways can we say stay adaptable, keep calm, and carry on? Basically, because that's effectively the message. Stay adaptable, keep calm, and carry on. Is there any other point that we need to make?
Yeah, well, I think the devil here is really in the detail. The headline is quite salacious, and for any of you out there, one thing that I would say to you is this really highlights the value of having the right advice, because I can imagine there's probably a lot of you that have heard, from your local broker down the road that doesn't really specialize in this sort of stuff, expressing some level of concern, or people online, pontificating that this is a disaster, but it certainly isn't. So it really just highlights why you need to seek out the right advice and work with people that are dealing with this exact challenge at the coalface, because when you unpack the headline and get down into the detail of it, as you guys have found out here, there really is not too much to be concerned about, provided that you're being steered in the right direction here to continue scaling out your portfolio.
Yeah. I think it's so interesting just how much commentary there is on this particular announcement. I think because, like you said, there's been a stacking of different announcements over the last couple of months that relate to this. So it's all kind of building. It's more in the headlines, but you see it even more in people's concern with comments and everything. It does kind of mirror like mainstream media matching people's general level of worry, when in the reality, speaking with you, Callum, who is actually dealing with this every single day, like, it's not that big a deal, guys. But to your point, it's like there's so much nuance in all of this stuff, because people are building out their portfolio strategies and they're thinking through their portfolio growth plan over the next 3, 5, 10 years. And I think the reality is, as we keep saying, things do change. So things are likely to change at some point in that 10-year plan that you have. Things are likely to get tighter. Things might get a little bit easier for a period, and things will adapt. And you can do that on your own, but you're better to have a team and someone who is, paying attention to all of this every single day, rather than just relying on trying to consume this stuff online and trying to do it yourself, because it's the nature of this industry that we're in, is it's constantly shifting, and it will keep shifting over the next 5 years as you keep growing a portfolio.
And I think the other thing which is built in with the compressed timeline of all these announcements is, obviously there was the general perception 6 months ago that we'd continue to see rate drops, which is not on the immediate horizon now. I think that's probably building into the flavour of how people feel about this. But if I think back to my time, in this industry, and compare it to some of the other changes that APRA made, previously, like when they really tightened up on living expenses, when they set a serious cap on higher LVR lending, like these restrictions they're trying to place here are far more moderate than what they have done in the past to try and achieve the same. And the result in those circumstances were pretty much the same. Have to modify your plan slightly and play on. And this time around, it's effectively a lesser, they haven't got as much weight behind what they're throwing around here compared to in the past.
Yeah. And I'll belabor the point, even though it's been made several times already, but like, the necessary willingness to be adaptable is like in this situation, it actually seems like you probably don't need to do much adapting at all, realistically. But to your point, Callum, sometimes things do happen which then cause you to need to adapt. You know, maybe something happens in the future, maybe a new policy position or regulation comes into play in the future. But that doesn't mean it's all over. It just means you like look at the circumstances and adapt and continue to play on. And I think, you know, the other part of this is as well is I think people have such strangely distorted views over the property market generally. Like people tend to whip themselves into a frenzy or have really distorted views. You know, like the whole kind of investment lending is dead is a very easy thing to get people anxious. And when people are anxious, they pay attention. And a lot of people's businesses, both inside and outside of property, so media businesses, but also property businesses, are built on how much attention they can get. You know, like, all right, what's going to get me the most YouTube views? Or, you know, by the way, I think we've used "Is Investment Lending Dead" for the title of this episode, right? So there you go. But, but like, you know, it's, but it does like, it kind of like whips that into a frenzy. But again, but realistically, like nothing's going on, and you do actually need. The point here is you actually do need to get into the weeds. I spoke to, and I'll just take this on a little bit of a segue because I think it's a useful addition. I was talking to a very large, I won't get into the detail of it, but I was talking to a very large organization in the property space and we were talking about Dashdot, and they said, oh, sure, but like the property market since 2022 has just been basically booming and been straight up and to the right. And I was like, that's a really strange perspective to have because like Perth did well, right? And like Brisbane, but I'm just looking at the data here, like in the March 2023 quarter, capital cities nationally, they fell by 4.5% for the year and regionals fell by 1.2%. So like nationally, the property market was down in all markets on average, right? And so if you December 2022, capital cities were down by 4% for the year. 2023 down by 4.5%. In June 2023, they'd only grown by 0.1%, and regionals were down by 0.6%. And so the point here is like people like form these opinions in their mind that actually aren't actually based on facts. They're like, oh, the property market's booming. No, it's not. Oh, the or investment lending is dead. No, it's not. And like you actually need to do is you need to take a step back and just go, okay, let me find the information here. like, can I understand what is actually going on? And if so, can I make better decisions? And almost every single time, it is just a case of just like calm down and carry on. Even if we go back to like when COVID hit. So I remember back when, end of March 2020, start of April 2020. That was obviously a very scary time because a lot of people didn't know what was going on. It was very unnerving. And so we took a position as a business, even though we had a whole bunch of clients that we were working with at that time. We took a position as a business. We said, for 2 weeks, we're doing nothing because I wanted us to stop and just try and get a sense of like, what is going on here? We said, like, in good conscience, we don't know. So for 2 weeks, we're going to do nothing. I'm just going to research. I'm just going to do research for 2 weeks. Did research for 2 weeks and then realized that actually, like, it was a non-event. In fact, it was almost certainly going to lead to a boom. Now, on April 14th, 2020, for me to be saying this is going to turn into a boom was just, to most people, absolutely insane to hear. But then by the end of 2020, everyone was like, oh, this is going to be a boom. It's like, yeah, no shit, right? Like if you just stopped for a moment and thought about what is actually happening, you might actually see the real answers are sitting right in front of you. And again, back to this specific circumstance, it's very easy for people to shout, oh, the sky is falling, and whip everyone into a frenzy. And it's like, well, okay, like what evidence do we have that is true? What are the actual facts? Why might these companies be making these statements publicly? Is this any different from actually what's going on? Do I even need to change my strategy? Oh, actually nothing? All right, well, why don't we just, shut up and crack on? Because that's really effectively what we need to do. And given that COVID was probably the largest event that's happened in the most significant disruption event that's happened in the last, 7 years, 8 years or so, for that to also have been like effectively a non-event that turned into a positive thing, like I can't think of really any circumstances that have actually really warranted, aside from like things like, changing yields require you to change your strategies, and, like changing interest rates, change cash flow on properties. And there's things like that which necessarily require you to adapt your approach a little bit. But there's nothing that's come along that has been like, this is an asteroid coming for the property market. Because we also have to remember that residential real estate in Australia literally underpins the entire economy. Like the government, the banks, no part of the administrative infrastructure of the nation can afford for residential real estate to go bad. The 75%, I think it is, of Australian wealth is tied up in real estate. I think it's, do you remember that stat? I think it's 75, 67, something like that. It's very high. It's like more than 2/3.
Yeah.
More than 2/3 of Australian wealth is tied up in residential real estate. So there is not going to be any policy that gets put in place which suddenly causes all of that to fall apart or to be damaged. Because what would happen, right, is there would be riots in the street, right? Like there would be politicians getting hung, drawn, and quartered for destroying people's household wealth. And so all of these things, I think we need to take into context that actually what is going to continue to be perpetuating is this a ways to continue to support the property market, not damage it. And I think it's a lot easier to stay calm when you realize that's at play as well.
Can I go back to?
You go.
Sorry, just want to debate for a sec, because I want to go back to my comment earlier about. I know. Going back to my comment about the APRA's kind of narrative around this is because we've detected riskier practice, and as you've said, our economy is largely riding on the Australian residential market holding up, right? So is there any argument to say then, because we can't let housing collapse,
yep,
that they're more likely to put in more and more of these regulations to try and make sure that it doesn't collapse?
I don't understand how that would make sense. So I had a conversation with a different but equally large organization in the Australian residential real estate space in the last week, and they wanted to understand a little bit more about Dashdot. And they asked a question. They said, because obviously we have Dashdot Finance and Dashdot, and they said, isn't there a risk that because we're helping clients to buy investment properties and we're also facilitating the lending, isn't there a risk that we're gonna overextend people's borrowing? And I just said to them, I said, well, that's what APRA regulations, and we have all these other policy positions in place. Like mortgage brokers have to follow rules. Like, so it's actually not on us. Like we can only lend the money that the lending organizations want to lend. We're not lending money. We're facilitating our clients to borrow money from these other organizations. And so the systems exist to kind of keep everything in check, right? And so I don't think that these policies, I don't actually think there is that much existential risk. It's not like suddenly the average DTI is now 9 or something like that. At the margins, there are probably some cases where DTI exposure has gotten a little bit too high, but that's at the margins, right? And so I don't think that is a representation of that the housing market is at risk, because you've got to remember that a lot of people draw parallels, and Callum, you've got a point to make as well. A lot of people draw parallels to the US, and they go, but in the GFC, that was caused by there was housing bubble, and that was all debt related in the US, and it all crashed. We've all heard, everyone's seen The Big Short, and ninja loans, no income, no job, no assets, lending. The difference, the very, 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 very big difference. Firstly, the lending regulations weren't in place there at all, right? So mortgage brokers were able to just effectively just write loans for it, but there was a lot of fraud going on as well, like people literally just making shit up and stuff going unchecked. But the other big piece of that was that the lending is based on the asset, not the individual. So people would borrow money for a house, and the lending would be based on the house, not based on the individual's borrowing capacity. And also, there was no non-recourse lending. There still is. So the borrowing would be made on the house, not the individual. And also, the individual could just walk away from the loan without any recourse, which is actually what started to happen in the US. So individuals they'd be like, okay, well, I can just go get loans based on houses, right? Like, so rental properties. okay, so the interest rate is 3%. This property yields at 6%. I can just get a loan. It's got nothing to do with my income. So they'd go and get all these loans. And then they'd overextend themselves, and then they'd maybe have shitty tenants that wouldn't pay or whatever, and then they'd start to default, and then they'd literally just walk away, and it wouldn't matter. That's structural different. We don't have any of that in Australia. So when we think about the nature of the Australian credit landscape, it's already designed in such a way that is very, very, very robust. And so I don't think like minor noise around DTIs, and it's not really like unless they turn around and say, all right, we're going to enforce that all lenders, bank and non-bank lenders, can only lend to a maximum of 4 times DTI or something like that. But what that would do would fundamentally destroy the Australian property market, because asset values would have to accrete down to make them, because someone who's got $1 million house wouldn't be able to sell it for $1 million. They'd only be able to sell it for probably $400,000-$600,000. So necessary asset values would collapse. That would undermine the economy. That would tank the entire economy. And the Australian government would never have a way out of it. So they would never do anything. Like they just wouldn't. There is just no.
Like, people that can't afford housing then need to rent. Then there's more demand for rental stock, and then pricing. It
would. So they're not going to do anything like that. In fact, what is more likely to happen? And so I've had a lot of interesting conversations in the last few weeks. I had a conversation with let's just call them a very large lending institution. Let's just call them that. And they were telling me with great excitement.
Was it Dash Finance?
No, a little bit bigger than Dash Finance, but we're close. We're close.
We're close.
Yeah. But like, no, let's just say like a very, very, very large, very well-known lending institution, who were very excitedly telling me that they're releasing a new product that is 105% LVR, and they're very excited to roll that out. And by the sound of it, they're going to do it on mass, and they've got a very large broker network that they're going to push that through. So, like the situation is that people are going to like, it's more
non-bank
likely.
Lender.
Non-bank lender. Yeah, and what's more likely is that governments and lenders and APRA and all of this kind of stuff are going to find more ways to lend more money to people, because asset prices keep going up and we have a housing crisis. And so unless they want to make the housing crisis worse, they're going to need to find more ways to go, it's probably going to be all right, and keep going, or at least keep the same position and not make it worse. Because if they make it worse, we'll have big problems.
Absolutely.
You have any other thoughts on that, Callum?
No, you covered a couple of the points that that I was interested in making. So it was a fantastic soliloquy. I think the only point I was going to make before is I think anyone in the group here that's present at the moment needs to repeat after themselves. I will not watch the news. I will not watch 60 Minutes. I will not watch. I don't even know what the other shows are these days. I'm not in Australia. I don't think we have to worry about you guys.
TV.
Free to air TV. Just stop watching it and stop consuming that as any source of truth relative to this sort of stuff. And I think if we think about the greater DTI conversation as well, it's worth remembering that anyone that's paying attention to this podcast, you are the exception in terms of how seriously you're taking your property investment journey. And DTI caps exist and are very useful in place for, let's say the uninformed, but just go out there and buy a bunch of high yield, low yielding investment properties that don't see any growth. Like, absolutely firm 6 DTI limits for people under those circumstances. Like, that's not something that should be toyed with. But the people that are paying attention here, it's like you're looking outside of that. You're investing in property like it's a business. You've got a structured plan in place to grow wealth with multiple acquisitions. It's a comparison of two completely different beings. And unfortunately, on the regulatory front, there's no allowance for this. It's just 6 DTI. So that's where the creativity and the debt structure needs to come into it to allow you to be in the second camp. Yeah,
love that. I have a saying that I used to have to repeat to myself a little bit until I developed the emotional position for it to be normalized to me. When I started investing in like equities and stuff, because they're way more volatile, like day to day, they go up and down and all that kind of stuff. And it's like, it can be a little exhilarating. So I had to have a little mantra to myself that the day-to-day gyrations of the market are not of my concern. And I just had to, every time I'd look at it, I'd be like, just the day-to-day gyrations of the market are not of my concern. That is not, I'm not here to look at what happens one day to the next. That's not why I'm investing. And I think it's kind of like the same point here with effectively the media and stuff. It's, it's all of those outlets you mentioned, plus all of the, all of the rest of the media, all of the print media, all of this kind of stuff. The day-to-day gyrations of the latest news cycle are not of my concern. You need to look at the fundamental structural reasons that you would invest in real estate. Okay, where do I think real estate is going to be in the next 5 years? Right? Because you're not investing for what's going to happen in the next 12 months. And I think it's reasonable, like when stuff like this comes up, to like at least just like curiously want a sense check, like, oh, okay, does this change anything for me? No? All right, cool. Like, let's crack on. Like, that's all good. Like, that's okay. But what you don't want to do is you don't want to get like emotionally wound up. Like, help. It's like, all right, is there anything to see here? No? All right, cool. Let's crack on. Easy. And just stay calm. I think everything's going to be fine. You'll end up being a better investor.
Yeah. I just think like life is too short for that kind of stress, is my perspective. Honestly, like we've all gone through incredibly stressful periods in our lives and shit happens. But if we have a chance to avoid that stress and just remind ourselves, like, it's actually probably okay. Like, I have a plan. I know what I'm doing. Like, I understand that the things go up and down and things change, and I adapt, and I feel confident in myself to adapt. Then release the habit of getting stressed about stuff that's not in your control as well, and just pivot and adapt in a way that you can control.
Yeah.
Avoid the gyrations.
Avoid the gyrations.
Only the bad ones.
Do not gyrate.
The good gyrations, let's keep them in play. So
what do you mean by good gyrations, Goose?
I'm picking up good gyrations. I'm not sure.
Perfect.
Perfect. Awesome. Well, I think we've covered everything we need to cover. So why don't we call it a day?
Why don't we call it a day? Awesome. Guys, thank you for joining us live. If you haven't joined us live and you want to join us live on another Friday, jump on to YouTube. We do it at 12 o'clock on Fridays, live here for an hour or so. You get to ask questions in the chat, join everyone else that joins us every week. It's a good time. If you want to hear more of these kind of conversations, actually, firstly, leave a comment. Let us know if you have any questions. We can pick that up. And if there's anything we didn't cover and you still want to know, leave a comment on the YouTube video and we'll get back to you. Otherwise, we do have a couple of episodes that we've done with Callum previously in the year. We did one which was about the Macquarie announcement a couple of weeks ago. That was a really good episode. So if you want more of this kind of finance lending conversation, you can jump back into that one. I'll leave that in the description below as well. I think that is all.
Hang on, I've got a couple of other things to say. So by the way, also
Perfect.
the how to build a property portfolio that pays for itself, also with Callum, also one of our
Also
most
good.
watched videos ever. Actually, might actually be the most watched video ever. So make sure you check that out because that's really beneficial to people to help understand that. Thomas English has just called you the Duke of Debt. So I really like that. That's another good one that we've got. So we've got that in there. Is there going to be a link below, Gabby, for people to book in with Dash.Finance if they
will
want to get perfect? So, and just to forewarned is forearmed. Callum is, not everyone gets to speak to the Lord. The Lord sits up on high. So if you book in with Dash.Finance, there's an amazing team at Dash.Finance that can help you. Great strategic mortgage brokers, great strategic team that is designed specifically with property investing in mind. So if you do want to get help to navigate the finance environment, lending environment in Australia in a strategic fashion that's going to be aligned with building a successful property portfolio, make sure you book in with the team as well. And yes, join us every Friday if you want, of course, you don't have to. But next week is going to be the last one for the year. We've got a special one next week. We have the Prince of Property himself coming on the show to talk to us about the current state of the market. This is going to be a very important one to hear because there's a lot going on the ground that most people don't understand. We're also going to be talking about what the state of play looks like going into 2026. So that's going to be super useful. But if you don't get to see these live, that's okay. Just make sure that you leave a comment below. Let us know that you've liked it. Hit the like button. That's useful to us. Hit the subscribe button. That's useful to us. That helps us to know that we're doing the right stuff. Yeah, that's all. And yes, Callum. Great one, Kim. Great comment. Congrats on your award, Callum, for you and the Dash.Finance team. What was it? Best broker in the universe? Wasn't it like Mr. Olympia of broking or something, like Mr. Universe or something?
Yeah, Mr. Universe, correct. That's what it was. No, the team have had some really good results last year. We won a bunch of awards, the aggregator awards.
Don't be shy. What awards did you win?
We won the greatest loan volume in Victoria by number and settlements, and also second Australia. Unfortunately, we got pipped, but yeah, some great competition.
Cool.
Nice. Great
Nice
stuff. That's
one.
huge. That's huge. Awesome. Congratulations. That's it. Let's go.
That's it. Thanks, Callum. Bye.
See ya.